Welcome to WealthWise. We are back once again with an informative insight on the trending topics in the financial horizon. This time it is cryptocurrency. Everybody is looking for the next big thing in finance. Cryptocurrencies, since their inception with Bitcoin in 2009, have promised a revolution in the way we understand and use money. These digital assets, powered by blockchain technology, offer a form of currency that is decentralized and theoretically immune to control by any single entity. This has not just caught the attention of investors, but has also sparked a global conversation about the future of financial systems. The allure of cryptocurrencies lies in their potential to democratize financial power, offering an alternative to traditional banking systems. However, as with any revolutionary technology, cryptocurrencies come with their own set of challenges and controversies. The lack of centralized control opens up avenues for misuse and fraud. The anonymity provided by cryptocurrencies can also facilitate illicit transactions. The rapid adoption of cryptocurrencies has been phenomenal, with millions around the globe investing in them. The question that remains is not whether cryptocurrencies will be a part of our financial future, but rather how they will reshape the economic landscapes we know today.
Decentralization is at the heart of the cryptocurrency movement. Unlike traditional currencies, which are regulated by central banks, cryptocurrencies operate on a decentralized network of computers. This network, or blockchain, validates and records all transactions independently of any central authority. This system not only reduces the risk of corruption and censorship, but also enhances transparency. For many, this represents not just a technological advancement, but a philosophical shift towards more democratic financial systems. The impact of this decentralization can be profound. In countries where the local currency is unstable or where governments are corrupt, cryptocurrencies offer a stable alternative. The peer-to-peer nature of transactions means that individuals can send money across borders without hefty fees or the need for a bank account. However, this decentralization also means that there is no safety net. If a user loses access to their digital wallet, there is no bank or institution that can retrieve the lost funds. This level of autonomy requires users to be more responsible and knowledgeable. As we move forward, the challenge will be to balance the benefits of decentralization with the need for some level of regulation to protect users.
The anonymity and ease of cross-border transactions that cryptocurrencies offer have also made them a favored currency in the black market. This aspect of digital currencies is often highlighted as one of their biggest drawbacks. From drug trafficking to money laundering, cryptocurrencies have been used to facilitate a range of illegal activities. The infamous Silk Road website, which was shut down by the FBI, is a prime example of how cryptocurrencies can be used in the dark web markets. This negative use of cryptocurrencies has attracted significant attention from law enforcement agencies worldwide. The challenge they face is significant. The same features that make cryptocurrencies attractive to ordinary users also make them ideal for criminal activities. Tracing these transactions requires new tools and strategies, as traditional methods of financial oversight are less effective in the decentralized digital world of cryptocurrencies. Moreover, the use of cryptocurrencies in illegal activities has implications for regular users. It affects the public perception of these digital assets, often casting a shadow over the legitimate uses and benefits of cryptocurrencies. Despite these challenges, it's important to recognize that the misuse of cryptocurrencies is a reflection of broader societal issues rather than a fundamental flaw of the technology itself.
As the popularity of cryptocurrencies has soared, so too has the number of scams associated with them. From high-profile Ponzi schemes to more subtle phishing attacks, the variety and sophistication of these scams have grown significantly. These fraudulent activities not only result in financial losses for individuals, but also undermine the credibility of the entire cryptocurrency ecosystem. One common type of scam is the fake ICO, initial coin offering, where scammers create a bogus project promising high returns and disappear with investors' money. Another prevalent scam involves fake wallet apps or websites that steal users' credentials and funds. These scams exploit the complexity and novelty of cryptocurrencies, targeting individuals who are interested in investing but may not have the technical knowledge to differentiate legitimate opportunities from scams. The consequences of these scams extend beyond individual losses. They create a climate of distrust that can deter new adopters and stifle investment in legitimate cryptocurrency projects. Regulatory bodies and the cryptocurrency community are responding to these challenges with enhanced scrutiny of ICOs, better educational resources for investors, and more sophisticated security technologies.
The regulatory landscape for cryptocurrencies is complex and constantly evolving. Different countries have taken varied approaches, ranging from outright bans to embracing the technology with open hands. In the United States, the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, have been actively investigating fraudulent activities in the crypto space and providing guidelines for investors and companies. These investigations are crucial in maintaining the integrity of the cryptocurrency market. They serve as a deterrent against fraudulent activities and help establish a framework within which cryptocurrencies can operate legally. For instance, the SEC has cracked down on several ICOs that were found to be violating securities laws, sending a clear message about the necessity of compliance. Regulatory actions also play a significant role in shaping public perception and institutional adoption of cryptocurrencies. Clear and fair regulations can provide the stability and security that institutional investors require, potentially leading to greater liquidity and stability in the cryptocurrency markets. As cryptocurrencies continue to gain traction, the need for a balanced regulatory approach becomes more apparent.
Cryptocurrency valuations are notoriously volatile. This volatility is partly due to the speculative nature of the market, where the value of cryptocurrencies is driven largely by investor sentiment and market speculation. For example, the price of Bitcoin, the first and most well-known cryptocurrency, has seen dramatic fluctuations, reaching nearly $65,000 in April 2021 before plummeting to around $30,000 just a few months later. This volatility is not just a feature of Bitcoin, but is common across many cryptocurrencies. It reflects the nascent stage of the technology and the market's sensitivity to news and developments within the crypto space. Factors such as regulatory announcements, technological advancements, and macroeconomic trends can all have significant impacts on cryptocurrency valuations. Despite the risks associated with this volatility, it also presents opportunities. For traders and investors who can navigate the market's ups and downs, cryptocurrencies can offer substantial returns. However, anyone considering investing in cryptocurrencies must be aware of the risks involved.
Looking at the historical price movements of cryptocurrencies can provide valuable insights into their potential future behavior. Bitcoin, for instance, has experienced several boom and bust cycles since its inception in 2009. Each of these cycles has been triggered by a combination of factors, including technological advancements, regulatory changes, and shifts in investor sentiment. One notable pattern is that significant price increases have often followed major technological milestones, such as the implementation of upgrades that improve the scalability or security of the network. Similarly, regulatory clarity or endorsements from high-profile figures and institutions have also led to price surges. Conversely, regulatory crackdowns or technological setbacks have typically led to price declines. These historical trends suggest that while cryptocurrencies are influenced by a variety of factors, certain events tend to have predictable impacts on prices. This can be useful for investors trying to anticipate market movements, although the inherent unpredictability of the market means that there are no guarantees. The rapid price changes can result in significant gains or losses within a short period.
As a digital marketing strategist, one cannot overlook the impact of digital marketing on cryptocurrency trends. The way cryptocurrencies are marketed has a significant influence on their adoption and perception. Effective marketing strategies can drive awareness and adoption, while poor marketing or negative publicity can deter potential users. Social media platforms, influencer endorsements, and content marketing play crucial roles in shaping public opinion about cryptocurrencies. For instance, tweets from influential figures like Elon Musk have led to immediate price spikes or drops. Similarly, educational content that demystifies cryptocurrencies can encourage more people to invest or use them. Additionally, the use of advanced digital marketing techniques, such as data analytics and targeted advertising, can help cryptocurrency businesses reach and engage potential users more effectively. These techniques allow businesses to tailor their messaging and offers based on user behavior and preferences, increasing the likelihood of conversion.
Predicting the future of cryptocurrencies is a challenging task, given their complex and dynamic nature. However, several trends suggest possible directions for the development of these digital assets. One significant trend is the increasing institutional interest in cryptocurrencies. Major financial institutions and companies are beginning to explore and invest in cryptocurrencies and blockchain technology, which could lead to greater legitimacy and stability in the market. Another trend is the ongoing development of regulatory frameworks. As governments and regulatory bodies around the world continue to study and understand cryptocurrencies, we can expect more refined and clear regulations. This could help reduce the number of scams and fraudulent activities, increasing public trust in cryptocurrencies. Technological advancements, particularly in the areas of scalability and security, are likely to continue. These improvements could address some of the current limitations of cryptocurrencies, making them more practical for everyday use.
In conclusion, cryptocurrencies represent a fascinating and complex facet of modern finance. They offer the promise of a decentralized financial system, providing opportunities for innovation and inclusion. However, they also come with significant risks, including volatility, scams, and regulatory uncertainties. The dual nature of cryptocurrencies as both a potential force for good and a tool for illicit activities makes them a subject of intense debate and scrutiny. As we look to the future, it's clear that cryptocurrencies will continue to play a role in shaping the financial landscape. For those involved in the cryptocurrency market, the key will be to navigate this evolving landscape with a balanced approach, recognizing both the opportunities and the challenges. The journey of cryptocurrencies is far from over, and it remains one of the most intriguing areas of financial innovation. Thank you for watching WealthWise. Please like and subscribe to our channel. Until we meet again, stay wise and grow wealthy.